Yes. So I welcome everyone. Uh, Good afternoon, everyone, all the respected participants today. And I, Abhijit Ghosh, along with my colleague, Ms. Sakshi Narayan from IIMT College of Management, welcome you all again in this session of FDP, which we are conducting in collaboration with the Indian Economic Association. It is my pleasure to welcome you all to the afternoon session of our faculty development program. And we are honored to have with us Dr. Sangeeta Srivastav, Head of the Economics Department and Assistant Professor, Vanita Vishram, Women's University, Surat, Gujarat. Ma'am has an extensive academic and administrative experience, and which will definitely help us to enrich our knowledge today. With over 3 decades of teaching experience, along with numerous research contributions in public finance, uh, international economics and marketing. She definitely brings a lot of valuable insight. She has also published more than 20 papers in international and national seminars, peer reviewed journals. She is also the Joint Secretary of IEA Gujarat chapter, and with all the short and formal welcome, which is very less that we can say today. Uh, Today, ma'am will cover the topic time series analysis, predicting investment return. We are privileged to have you here, ma'am, and I hope your expertise and vision will guide us towards further excellence. I welcome you again and will ask you to please take over the session so that we can start the session and learn more from you.
Thank you so much, sir. And first of all, I'm so honored that you have given me this opportunity to. Uh, this is the, you can say, the learning and sharing process. So we learn it together. It does not matter that I'm just giving something. Even I'm also learning by sharing my knowledge as well as sharing the taking the view and the review of you people. So it is. I'm thankful to the management of IITM who always very kind to provide us this type of opportunity, and they conduct this type of academic programs. That is good for us as well as for the participants also. So thanks to IA also that they always do this type of collaboration process. So by sitting at in our institution, we are able to be the part of these type of academic teaching learning procedure. So I'm moving towards my topic without you can say the wasting the time. So thank you again. So I'm sharing my PPT. Shall I share it? Okay.
Yes, ma'am, please do.
Hope everyone can see and listen me.
Yes, ma'am, we can see, and
Yes.
yes, voice is also clear, ma'am.
Okay. So the topic that is allotted to me, it is the time series analysis predicting the investment return. Uh, since 11th you are doing all these points, And yes, very obviously, you might be have gone through with what is time series analysis, what is demand forecasting, and what is the role of time series analysis, uh, in which area it is very effective, and how many types of demand forecasting, that the basic things already you might be having. So I have taken the various, you can say the very specific point here, that is the how the time series analysis predicting the investment return, how it is valuable to understand the investment return. So I'll be just sharing this data. So you can see here that you can see here that I have taken the data of 5 different years: 21, 22, 23, 24, and 25, of the whole year, January, February, March to December. And if we go with these data, so we can observe that there is all the data are not symmetrical, and even in particular year, there is a changes, there is a fluctuations. So by going through this data, we can summarize in this way that in 2021, it was the robust year, because if I'll check from April to if I'll check from the April to December, yeah, so there is a continuously strong increasing. You can see here April, it is from the month of April it was 5.1, and then in August again it was 5.4.1. So there is no, you can say, the major decline time here. Other than high returns was there, especially particular 2 month, April and December. So this indicating that the market performance was good in these times. In the same manner, if I go with the 22 data, so you can see, you can find here that yes, in there is a fluctuation. It was initially it was 2.5, then it's become 3, then it's become in April it's become 4.2, and then in the month of June it's become negative, and then July. So there is no steady scenario of the data in this in these years in 2020 in the different months. The same is the situation is what we are getting here, that in 2022 the return fluctuates with a significant drop in month of June, likely reflecting market volatility to other economic indicator and the economy scenario. Same here in 2023, there is a gradual recovery, maybe because of some, you can say, the some instrument that will be introduced by the government with improved result and the consistent growth in the second half of the year. So why I have given this data? This data provide us, because this data is regarding the whatever the data I have taken, this data is regarding the financial performance of the market. So what this data predict, this data give us the idea that in which year our economy is healthy, our market was healthy, the in market financial market environment was healthy, and in which year the performance of the market was not good. So these are the hypothetical data, they are not the exact data. So here the hypothetical data sheet provide a clear picture of the fund performance in different time period. So why I have taken this data? Because suppose we as an investors, we look forward to put money somewhere. How I can get the idea that the performance of the money will be, performance of the investment will be good in future? What type of response and the return we will get here? There is a one example that is very, you can say, right now it is a sense, it is a, you can say, it's become the world census, that everywhere the people are rushing towards the Prayag Kumbh. So again, the question comes that, and from day one, we were listening that 45 CR people are coming. So how we estimated this? How we get this idea? How we make preparation accordingly? So what type of forecasting is needed? What tools are there, and how the time series analysis help us to get such type of uh, forecasting? So this is up now the question. There is a two things, one for the short term forecasting and the second is the long term. Where there is a such type of event we forecast, then it is not necessary that we have to get the you can say the many years data. But the matter when we put your money, it is the when the it is the matter of investors, then we have to be very clear about it, that any wrong calculation will give the wrong result. Our prediction will be wrong when you are putting your money somewhere. So the topics why I have taken this thing, because yes, we know that the every investor need return, and then this return process is not a short term concept. It takes time. You are putting your money might be for the 10 years, for the 12 years. So how you get this idea, how you get the how you forecast this, how you will calculate that in future what return you will get. And to understand this concept, I have taken this topic, that time series analysis is the prediction of investment research return. Okay, so this is not only regarding the you can say the product forecasting. It is not only regarding the small you can say the some specific product or the simple demand forecasting. But by going with these concept, we can get the response of our investments also. Suppose a venture capital, they are in this process, they are putting their money in the different industries. So what logic they use to invest their money, how they calculate that what return they will get after 10 year, after 15 year. And by going through this thing, they will be ready to invest their money. They are ready to put their money. So am I audible to everyone? Yes, yeah, I
Yes,
know.
ma'am. You're yes,
Yes.
yes. You're
Okay.
audible, ma'am. Yes.
So in this regard, that we have to understand time series model. I hope that in coming lecture, sorry, in the last lectures, you might be aware about the demand forecasting and what is the quantitative and quantitative aspects of the demand forecasting, and then how many types of the demand forecasting. That you might be have gone through with all the points. Even you even in a journal study, simple study, we learn all these things. But how this time series model is very helpful when we are looking for the investment and when we are estimating investment in future. We are looking for the returns in future. So we know that the time series analysis is a powerful statistical technique, because to get the quantitative aspects, to manage the data or with the help of quantitative aspects, that give us the more accurate data, more accurate result. And the time series analysis is the, you can say, the proof of this thing. So it is a analysis that is very powerful statistical technique, yes, we all know, to analyze the time ordered data points. Time ordered data points means where we calculate the data on the basis of the year, on the basis of the month, and in this, in the context of the fund management, it play a crucial role in predicting future trend and making informed investment decisions, because this help us to predict your investment in different, you can say, the different companies, different stocks, and for the investment purpose where you are looking at. So how we use the time series, how what is the procedure we do this thing. So time series model use the series data on the demand verification, uh, as the demands are varying, changing, and it is the exclusive functional time alone. So here we use in a continuous series process and on the basis of the time. So as I have taken in starting that in example that I have taken the data from 21 to 25 in a continuation, that is the January to December. So under time series process, we are more focused towards the time based data, and because in the different demands variable, treating it as an exclusive function of time alone, because here.
Ma'am, you are not audible.
Yes, yes.
Yeah,
It's
okay.
not,
Fine.
I'm having little problem. I'm not able to change the PPT. Wait a minute. Huh?
Okay, okay.
Okay. So, and the second thing is why the time series model is more approachable to all of us, because it is this data need only and only dependent variable that can focus for even a very short period. It If we go with the demand forecasting concept, that majority of the analysis are based on the time series model. If we find out the cases, then majority of the time series, you can say the demand forecasting is based on this model only in the quantitative aspects, because we consider we get the data here, we get the result here from the short term period to a long term period. If we are looking to have the so if we are looking to have the information for the short period, then it is very easy to include in the analysis, as well as for the long run obviously we use it. Then why? Because it is based on the continuation of past trend in future. So it's easy for us to correlate. It's easy for us to analyze, and because it is based on the dependent variable. So the analysis is it's become more accurate rather than using the other methods. As you see the data here, you get the idea. As the Trumps has taken the Trumps become the winner in the very same time, the Indian stock market also crashed on the day after the US election result was shown. So why the people has gone through with this action? Because it is a very surprising na, ki, the Trump has taken the oath over there, and the Indian stock market, the Indian stock is immediate fall down. So these are the examples that give us the idea that how the time analysis give the clarity about the coming futures, give the clarity about the markets, give the clarity to the investors. So the people are very much aware that when the terms was the earlier, in the last in his last phase, yeah, you can say in his uh, last when he was the you can say the president of the US, at that time he immediately changed the policies, and the people were predicting that this time also they are going to change the policy regarding that. So the Trump previous tenure included significant change in the trade agreement. Even this time also you can see, by taking the seat immediate, he put it the tariff and other things. So uh, so this gives us the idea that the information that we are getting here by using the time series analysis, there is a, you can see that there is a dependent variables. They decide, they give the clarity about, they give the somehow the idea about what the future may be, what the prediction can be done. Okay. So if I go with this thing, so with lead investor to speculate about the future volatility and the uncertainty in the international trade, and this can create a cautious atmosphere in the market, and because of that, the impact definitely was on the Indian stock market. And seeing this thing, the people those have invested over here, they withdraw the money, new investor were not there, so because they were analyzing that the market will be going to down. So in time series analysis, whatever the demand forecasting we do, it is based on the time relation established with the dependent variable through a formal model. Uh, might be you have gone through with this thing that we forecast, we predict the thing on the basis of two aspects. One is the quantitative and the second is the qualitative. So under qualitative, there are other method also, but under the time series analysis, there is a proper formal models, and the prediction of the, you can say the result, the prediction of the return can be calculated more accurately here with very less error. So this is why this analysis is more, you can say the considerable analysis for the, you can say the investor, for the predictor, because so there is a one example you can also add here, that the market uncertainty, whenever the Trump has taken the, you can say the position, the election of the Republican presidents often prompt concern about the protectionist policies and potential trade wars that we can see right now also. And this create the somehow the dilemma among the investors, among the business peoples, that obviously the market is going to be uncertain. So investor may fear that Trump approach could impact India export driven economy, particularly in the sectors like IT and pharmaceuticals. So you can just analyze, you can see that what is the scenario right now. The people has taken the decision on that day, and the impact that we are seeing here, we can see this time. So this is only possible because we get the idea somehow by going with these type of analysis, by using these type of formal models. So under time series analysis, you can say that in the forecasting process, there are the two way we can, there are the two models that we can work on it. The one is, that is the Navy model. It is the older one, where basic forecasting method, where the prediction for the next data point or the simply the value of the most recent observation, where we predict the very short term response, uh, where we can use this one. Simple the seasonal change, simple, you can say the demand of any FMCG type of product. Yeah, the small, you can say the returns where we can consider. But when you are looking towards the long term aspects, when you are looking towards the, you can say the 5 6 year or the 10 years differences, at that time you wish to find out the result, and on that you wish to calculate these results in advance, then is it not much appropriate as an entrepreneur? Suppose if a guy, I taking the example of Navy model. Suppose I wish to use this Navy model for the long term. So what will be there? I will not get the perfect data, because you are the focus. Suppose I have taken this one a small, you can say the example. You are forecasting daily sales. So for this thing, the vegetable persons, the grocery peoples, they can use this Navy model. Here you will get the data regarding, you can say the day-to-day prediction is possible. But for the long run, for the long period, this model is not very appropriate. So then what is the appropriate way? Which type of model we need to use under the time series analysis? So we can consider, and the biggest issue with the entrepreneurs, because many investors are looking to invest on the startups. So how they will predict it? How they will predict the returns? Because right now there is nothing is with you people, nothing is with the startup. So here this,
Your video is stopped.
yes, give me 1 minute.
Give me 1 minute.
It's some technical.
Technical.
I'm connecting again. I'm uploading it again.
Okay.
Already it is there, but won't be able to see. You won't be able to see this PPT? Please let me
Yes,
know.
we can see. Yes, we can see entrepreneur.
You can see entrepreneur?
Yes, I can see them.
Okay. So yeah, I will be able to see this. Now you are able to see now? Okay.
Yes, I can see.
Yes?
Yes, you have just moved back and forth.
Okay.
Yes.
So this was the example that we can use in the Navy model, but we are looking towards the investor returns. So then definitely this model is not appropriate. So what we can do the next, that is known as the trained model. And under this trained model, there are the various methods that we apply to use to know the investor's return, to get the idea. So first we need to understand that what is trained model exactly. Many of we are aware about it. So it is a statistical or the mathematical tools used to analyze pattern over time, helping to predict future value based on historical data. and they are particularly useful in majority of the field, you can say. Even if you consider the recent example of the Kumbh Mela, this also has been gone through with this type of, by using this type of model, because we collected the data from the background, you can say the past data, that the people are little bit keen to attend this type of spiritual, you can say the uh, gathering. And by analyzing such type of data, we were predicting and that the people, maximum people are coming there, and it's really, it was somehow, you can say, really near about to that. It was predicted that 45 CR people are coming, and if you go with the data, so you can get the idea that near about, including the yesterday, the data is, it is near about 46.5 something. So under this train model, there are you can say that there are many methods that already we have gone through: linear train model, exponential train model, polynomial train model, moving average model. Normally in normal practices, we do the linear train model, exponential train model, moving average. Seasonal decomposition of the time series, ADEMA, we do this thing, autoregressive integrated moving average, and Hall-Winters method. These are the, you can say, the methods that we generally use. So here we are not going to discuss what is the least model, what is the exponential trade model, because already we have done these things. Already we do these things, these basic, the practical questions we do on these things. The questions comes here that which one is the most appropriate model that is more suitable for the investor's point of view. So in general, if we analyze that the trend, overall, if we analyze that the trend model is very much appropriate in maximum field, either it's a business, companies use the trend model to forecast and they make the informed decision. It's either it's a business, either it's a finance. Investor rely on the trend analysis to identify potential stock or the market movement. Obviously, this is you can consider this thing correlate with the US stock, Indian stock market, when US president has taken the position. Healthcare field, analyzing trend in the patient data can help resource allocation and the public health planning. Environmental science, very obviously, not tracking change in the climate change, because by analyzing the, you can say, the last year data, somehow we predict the data regarding this. Okay, so here, these models are majority of the model. Yeah, you can say these models, all are the models that we are using here. It's either it's a seasonal, ARIMA, linear trend. These are the very helpful in predictive insights. Either it's a expected return, either it's a volatility of the market, potential market shift, fund managers to make the proactive decisions. In by going through the time series analysis, we can by going through the time series analysis, we can predict, we can get the idea about whatever the returns, whatever the expected response we will get. To understand this concept, because I have taken a small case study here, predicting investment return using the time series data, because the main points that I wish to share with you guys is how time series analysis is helping us to get the idea about the investment return. Entrepreneurs, the investors, those are putting money on the startups. Investors, those are angel investors, those are giving money to the entrepreneurs. On which basis, how they predict it, that this venture will be beneficial in the future. So to understand this thing, I have taken a small case here. So we are going with that one. So suppose a goal is to predict future investment return based on the historical time series data, because here we have gone through, when we I find when we have gone through with the application of trend model, that we use the term that we collect the data on the basis of whatever we predict the future value, that is based on the historical data. So we are trying to find out how historical data help us to get the accurate result. Is it genuinely true? The result, how much the error we receive by going with historical data, or it is okay to to analyze the future investment, to predict the investment by using this type of data, historical data. So the objective and the importance is that to get the accurate prediction that helps investor to make informed decisions, manage risk, and optimize their portfolio. So I have not used any, you can say, the mathematical aspects within, because in 2 hours it's not possible to elaborate all these things. So I have taken just a summarized aspects, all the points, and basically I focus towards that how this trend analysis is helping to provide the investment return, to get the idea to predict the investment return. So here we will be going try to collect the source of data, that is the historical price data of a particular asset, stock, mutual fund, or the ETFs, from the financial database like Yahoo Finance or Google. And the one thing that I would be like to share with you guys, that the second, to get the result, to predict the result on the basis of secondary data is more appropriate, more authentic, and somehow it is more result oriented rather than going with the qualitative data. So time series is fully the secondary database concept. It is based on the secondary database models. So whatever the data we collect here, it is definitely from the approved database system. So this is why here the data that we try to collect is the stock, mutual fund, or the any other financial aspects. So the time frame, initially I have taken this thing, it was the 5-year, and focus area is the focus on the closing price of the stocks, volume, and the possibly other factors like dividends and other things. So now the question comes ki how we will do this process. Suppose we are looking to get the idea, suppose we are looking to calculate, then how we will see this, how we will collect the data, how we'll manage the process. So data processing system is what we have to use this formula. I think you might be aware little bit about it. Somewhere it is mentioned that the RT is also mentioned. Somewhere it is mentioned RT equal to PT minus 1. That is the difference years divided by PT minus 1. So return at the time. So return from the price data, the daily return can be calculated, because by getting the idea about the daily return, we can somehow the incorporate and expect, and somehow we can guess it, that the by using this formula, RT is equal to PT minus 1 whole divided by PT minus 1. So RT is the return that we are expecting at a particular time. The time is given T, because suppose we are looking, we are putting money right now. And after 3 years, how much money we will get back? So for this thing, this formula is very appropriate. And PT is the price and T is the time. 1 minute, I have to. So by going through this aspects, we can calculate our investment returns. And this is the most simple way that we can use when we are going with the time series data. Beyond this, the different type of methods that already we have done these things. Already we are knowing little about all these things. So if you're looking to for the you can say the investment return, that involve one point. By going through this all the concepts, we can say we are using the time series data. We have to first collect the data, and this data is the collection of the data. This data is the process. We can collect the data from the historical, you can say, the database, and from the second historical database, definitely it would be from the secondary data aspects, secondary sources. And then by using the you can say the modeling, and we can evaluate that what result we are having here. So comprehensive guide to help you this process. So first thing is that when you are going to collect the historical data, what precautions, what understanding you have to have. So under the data time series analysis, one thing that you get the clear idea that for an investor, the time series analysis is the most appropriate way to collect the data. Now second thing is that time series analysis is based on the secondary data. We have to collect data from historical aspects, historical trend. So then we need to understand what is this historical trend, how we have to identify. So it's begin with the collection of historical data on fund performance, market indices, interest rate, and economic indicators. When we are looking to get the idea about the returns, what we are going to get. So by examining the historical performance, any fund manager can identify the trend. So because of that, in very starting, I have taken this data, and by analyzing this data as a manager, you can get the idea that what type of response, what type of return you can get in future. And by going through this analysis, the people of the you can say the investor in the Indian stock markets are very keen to put their money back when the Trump has taken place. Trump in his next inning. And right now we are the witnesses of that thing, that whatever the decision has been taken by investors in that time, if they were not taken this decision at that time, they will be in the loss. Even recently I was going with some interview that I forget the name of the person who told that we have to withdraw our SIPs investment and the small investment that we have done very soon. Otherwise, we will be in the loss. So how they predict these things? By going through this type of, you can say, by going through this time series analysis. So you can say, being an investors, being a fund manager, venture capital, we can identify the trend, seasonal patterns, that is not much appropriate in the investor aspects, but more but cyclical movement is definitely it would be very, very helpful for us, which give the future predictions to put your money somewhere else or in other area. In the same way, if I consider the other models here that we have put it, you can say, in the different types of trend analysis. So there are few other methods that help us to getting the idea about it. One is the autoregressive integrated moving average and exponential smoothing, seasonal decomposition, utilized to model and forecast future fund performance. This also based on the historical data. So there are few models, those are directly based on the historical data and the form, by putting the form, you can say the data, by analyzing the data, we get the clear idea, somehow the 80% accuracy of whatever the future prediction is there. Even time series data analysis also help us to analyze the volatility of the fund return over time. So I think that the case study of US Trump, you can say the case study of this present time of US Trump, you can say the presidency is the clear case study with us, where we can put this time series analysis to get to understand the, you can say, the whole world financial volatility that is going on right now, which is essential to understand. Then to calculate the risk, past price movement, fund managers can estimate potential losses in adverse market condition, adding in risk mitigation and strategies. Asset allocation, the time series analysis also help us to, in the dynamic allocation of your whatever the you can say the stocks you are having, the bond you are having, so we can predict the performance by using this time series analysis in the different times. And rebalancing studies, fund manager can adjust their portfolio based on predicting the trend, ensuring optimal allocation of the resource and maximizing return. So overall, there are the many points that we can consider in the favor of time series analysis, that this is the very, you can say, the appropriate tool that we can use, not only the prediction of the investment result, but we can utilize this time series analysis in risk management, in asset allocation, as well as the performance evaluation of your fund, the performance evaluation of your funding instrument. So you can compare also the fund performance against the benchmark and indices over time. This helps us to evaluate the effectiveness of the investment strategies. That is very helpful to take the decision when you are looking to invest your money somewhere else. Contribution of different factors, because this analysis is based on the dependent variable. So we can also analyze what type of contribution the different factors are doing here, how they are helping us to perform better, and what are the factors those are not supporting in the performance, those are not, you can say, those are not very much contributor in the performance. So this is also help us to refine investment strategy, because because for an investor, for a entrepreneurs, to get the fund, for the entrepreneurs is a very tedious task, and those are associating with those firms, those are associating with the startup, for them it is again a very tedious task to get the money revert back. So for this thing, it is necessary that we have to have the clarity about how the performance of the investment will be there after some time. So in that regard, the time series analysis is the excellent procedure that give us the idea about the return of the investment. Along with that, this analysis is used under the fund performance and economic indicator. You might be little bit, you might be very much aware about this thing, that the performance of the fund directly correlate with the economic indicators. When economy can perform better, when the performance of the fund are positive. And sometimes the investors attract because of these economic indicators. If the economy is performing better, so the people put more money over there. There is an example you can consider here, the Dubai. Because of the performance of the economy, the investors are running towards that. You can take the example of, if I consider the example inside the India, so there are the 2-3 metro cities, those are getting maximum FDIs, even not the FDI, forget it, the FDI, if we are looking for the investors. So we can get the idea that the few area of the countries are most preferable area for the investment. So depends on what type of economic indicators are, how the economic indicators are performing over there. So predictive signals, change in these indicators can serve as signals for future markets movement, assisting fund manager in the making timely decisions. So these are the points that we get here, that the time series analysis is it is just like a combo aspects. It is just like you can say it is just like a tool that is not only helping in to getting the return, to get the forecast only in the you can say the limited field, but this analysis, this time series model is a model that can be used as a you can say the to analyze all the aspects of the economy. It is related to the health aspects of the economy. It is related to the you can say the environmental aspects of the economy. It is related to all the financial different you can say the derivatives of the economy. So it is able to provide all type of you can say the diversified type of help to understand the economic health, to that include all the financial you can say the all the financial tools, that include all the financial strategy for the not only for the investors, but overall the people those are living in the country. So the potential impact of the fund performance, strategic planning, this helps in developing contingency plans and strategic response to various market conditions. So in this way, I have taken, tried to cover in a very brief manner what exactly time series analysis. I try to cover how this analysis is helpful in the different fields of the economy. And then the major aspects is that how it is helping to an investors, those are looking to invest in the entrepreneurship field, those are looking to invest in the startups. So before putting their money in you can say the in startup area, in the we by going through this time series analysis, we can get the idea, we can calculate the risk involved in the investment that can be easily predict and calculate by using this time series analysis. Depends what type of data you have, accordingly you can use the different methods of the time series analysis that is already you have done. So there are different methods that are under this time series analysis, and as per our data we can utilize these things. So it is a very brief concepts that I try to cover, and obviously because it was not possible to take all the, you can say, the all the type the cases of all the types. So I have taken a very simple aspects, where we can understand how the historical data can be collected here for the all type of financial, you can say, the performance, and the formula, that is simple formula that is here to understand to get the return. And what are the other areas where we can utilize the time series analysis? So from my side, these are the points that I wish to share with you guys. Anything that you wish to share with me is most welcome.
Thank you so much, ma'am. I would request everyone present in this meet, if you have any queries, please ask your queries. Please ask your questions if you have any. And I would also request people to please open up your camera for a photo session so that we can have a joint picture with everyone. So first we'll
I'm a little
take
bit
up the...
sorry because but
Yes, ma'am.
this is why I have to stop my lecture here only.
No problem, ma'am. It's absolutely fantastic because the whole mankind and the interest is towards predicting the things, that how you actually predict to gain maximum from what the occurrences that will take place in future. So time series, how it is important and how it plays a very important role. That's a fantastic example of Mahakumbh, that how you are predicting that 45 year people will be there. So these are the very common things that we are totally involved in, but we never take a look or pause and think to calculate the things or to see it from a very typically theoretical point of view, because it's too a part of our life, very commonly engrossed in our daily life, that how we think and process data, but we do not go behind that calculation part, behind the data and the calculation part that is there in the uh, thing. So it's actually a very fantastic session that we had, and that is why we are open for any kind of questions or queries that you have related to the session. Ma'am is here to answer. And if not, then we'll straightly go for the joint photo session for the, and I would request everyone to please open up your cameras.
Already I have opened the camera. I'm on screen.
Yes, you are already on the screen. Ma'am. The request that I'm making to all the other participants who are there, so kindly open up your cameras, please. So since thank you everyone, and since there are no more queries related to the session, uh, we would request everyone to fill the feedback form shared in this message chat box, and I will also share it on the group. And I would request everyone to please join us tomorrow again at 10:30 a.m. for our next session. Thank you so
One
much,
thing that
everyone again.
Okay, sorry. One thing that I would like to request to all the participants, because please be very honest by sharing the feedback, because this gives us the somehow the corrective. You can say the uh, effort to us also, that we can include maximum thing that and make our sessions more interactive and more you can say the effective. Because if you are not going to share your feedback, so we are not able to work on it. So this is not the one way process, it is the two-way process, that many times the you can say the person who is sitting this side feel very confident that whatever I deliver it was the excellent, but I don't think that whatever we deliver it is always excellent, because the listener must be very much satisfied what in which objective they are here, what they wish to learn. And because you are giving your time, so you have to get the best. So at this part, I personally request you guys that you give your suggestions, that when we conduct such type of quantitative aspects based you